Hey, and welcome to the Interaxis YouTube channel and Interaxis.io. Today we're going to try to explain a little bit about decentralized finance, really just what it is. The acronym we use for this is DeFi. So to start talking about decentralized finance, first we have to talk about centralized finance. What is centralized finance? Centralized finance is really what we've been living under for quite a long time. What it basically means is we have centralized a lot of the infrastructure and a lot of the needs we have in the financial world with a few entities. Some of those entities are the government and banks. Okay, and here's what we have centralized with governments. Governments are essentially in charge of monetary supply and the valuation of money, right? And they offer a lot of insurance. In our case, in the case of the U.S. government. Banks, we've outsourced a lot of the custody of our money. We've outsourced the transfer, so my ability to send money from one place to another. And we've outsourced a lot of the lending of money. So when we talk about lending, we talk about the multiplier effect. So money multipliers, meaning I can put my money in the bank, they can go lend it to someone else who can utilize it for their purposes, and we see what's called the velocity of money. Money being able to perform more than one task at one time. Banks help with that because they lend it out, and for that they get some fees. So what happens here in centralized finance? So let's say we have two people, Adam and Ron, and I use those two people because that's the two people involved in Interaxis, is Adam and Ron. So Adam wants to send $100 or give $100 to Ron. At this point, I might write Ron a $100 check. Now Ron accepts that check for whatever products or services he provided, and he does it because we trust each other. Right? We have some level of trust in each other. Ron accepts this check, which is really just a piece of paper saying, I promise that I have $100 and I'm going to give you that $100. Ron accepts it, gives me whatever goods or services that he provided. He takes that check and he gives it to his bank. So let's say Ron is at Bank of America. Ron deposits that check. Bank of America says, okay, Ron, we'll put this in your account, but we don't really trust that this check that Adam gave you is good. We're going to talk to his bank about it. Let's say I bank at Chase Bank. Bank of America talks to Chase. They said, does Adam have this $100? Chase says, well, of course Adam has it. Bank of America says, all right, send it to us. So they wire Bank of America $100. Bank of America puts it in Ron's account. Ron can now spend it. All of this had to happen for me to write Ron a $100 check. Now we all know that technology has come in and made this process a lot easier, right? I can use things like Zelle or Venmo or some other way to get Ron this $100 very quickly. But in the background, all of this is still happening because there is a lack of trust that anyone actually had this money. So this is the part of the centralized world. Another part of the centralized world we'll talk about is lending. So let's say Adam has $100,000 sitting around doing nothing. Ron says, I need to borrow $100,000 because I'm going to start this business called Ronco. Not to be confused with the guy who made the fryers and the dehydrators. Ron's going to start Ronco, and he needs to borrow $100,000. Well, I have this $100,000 sitting around. I want it to be safe, but I say I might want to earn a little bit on it. So I take it somewhere, and I say, can you hold on to my $100,000 for a while? And they say, sure, we can hold on to your $100,000. We will keep it safe and make sure that no one takes it, and if you ever need it, we'll give it back to you. And we'll also give you about 1% interest to hold the money. I say, okay, that's great. I'd like to know that my $100,000 is taken care of. Meanwhile, Ron goes somewhere and says, hey, I need $100,000 And I promise that if you give me this $100,000, I'm going to invest it in my own company, and I'm going to pay you for that privilege maybe 5%. And this entity says, sure, we'll give you the $100,000, you pay us back 5% plus this $100,000 and we're good. By the way, we're going to look at your credit report, we're going to look at your business plan, we're probably going to take some collateral from you. So if you don't pay us back, we're going to take whatever this collateral is. Maybe it's your business or your car or some cash you have or something. We're going to make sure that if we don't get this $100,000 back from you, we're going to take something else that's worth roughly the same amount. Ron says, sure, I'm confident in my business. I'm going to borrow this $100,000. Now this entity that's in here that holds on to my money and pays me some small interest rate and lends out money to Ron and has him pay an interest rate, we call that the bank. And for the bank to do that, they charge this interest rate. So Ron's paying 5, they're paying me 1, so they get 4%, plus they get fees to be able to go through this whole process. They get the fees because they've had to go through the process of making sure that Ron is going to pay him back, making sure that they can get access to that collateral, all sorts of things. So the bank is there for these fees. Now, we might go, well, why should the bank do that? Why can't Adam just lend the money to Ron? Well, I could lend the money to Ron, right? But the problem is, there we go back to this issue of trust, right? We have to have complete trust in each other. I have to trust that Ron is good and this company is going to succeed and he's going to be able to pay me this interest rate, and I can make that 4%. I say, Ron, I'll charge you 4%. I'll let you borrow the money. And Ron says, okay, great. We know each other. We trust each other. I'm going to keep paying you this 4% and I'll pay you the $100,000. And if not, I'll give you my car. We shake hands and we're good. This is what's called a peer-to-peer lending. The problem is this situation here is not scalable, right? Because all the people like Ron who need to borrow money don't know all the people like me who have money to lend. We can't find each other. And on top of that, even if we could find each other, there's no guarantee that we would trust each other, right? So the bank steps in and says, okay, we will broker the trust, essentially. We'll take all this money and pool it from people who have money, and we'll take all these people who need to borrow. We will vet them. We'll put a process in place. We will take on the risk, and we'll lend them money. We'll make our cut in the middle. We'll take our fees. Okay? That's how the banks operate. On top of that, because I want my money to be safe, the banks have even outsourced some of the risk to the government, right? You've heard of FDIC insurance, which means that even if all these people like Ron cannot pay the loans back, and all these people like me want to take their money out of the bank up to a certain amount, and the bank says, well, wait a minute, we don't have everyone's money sitting around here, we can't just hand it all out. The bank then goes to the government says, you know what, we'll make it good for everyone. We'll make sure that Adam and all the other people can take their money out of the bank. So the bank has outsourced some of that risk. So the way we got to this whole centralized system, right, is we had to outsource the trust and the risk to some bigger entities. And those entities are the banks and the government. And for that, those banks and the government charge fees, they create friction, and they impose regulation. That's the cost of outsourcing trust and risk to banks and governments. Now, they're not bad, because when you evaluate the other options, we didn't really have other options, because the situation where I can loan money directly to Ron is not scalable. The situation where I can have my money sitting in coffee cans under a mattress is not scalable. It doesn't move the economy forward. The situation where I can outsource the trust and the risk to a bank, the bank can lend money to Ron, the bank can feel comfortable that the government has their back, that is the situation that allows our economy to move forward. So the centralized way of doing business has always been very important. However, now we see that there's a new opportunity. And that new opportunity came about with the advent of something called Bitcoin. What Bitcoin did, brilliantly, was make it, in a nutshell, to where I can send Ron 1 Bitcoin, and I can do it without writing a check or anything. And the reason that is, and the reason that I can do that, is because I have to have this Bitcoin electronically in my electronic wallet in order to send it. There's no way for me to write a Bitcoin check. There's no Bitcoin Cash bills. I have to go into my electronic wallet and have it send 1 Bitcoin to Ron, and the only way I can do that is if I had that Bitcoin to begin with. So after about 30 minutes, which is actually a pretty quick amount of time, Ron would have that Bitcoin in his wallet and be able to spend it. And this seems like not such a big deal in the days of Venmo and Zelle and such. But that whole process I drew earlier doesn't have to happen anymore. We have outsourced now this idea of trust and risk. It used to be outsourced to the bank and the government. We have now outsourced it to computer code, which sounds very Matrix-like, sounds very Terminator-like, that we've outsourced all that to code. But what we've seen is over the last 10 plus years, Bitcoin has worked. We have been able to outsource the trust and the risk to this code, and it's worked very well. There's tons of Bitcoin out there. The transactions happen pretty seamlessly. They happen all the time, and what it means is we can move forward. So Bitcoin was the first case of decentralized finance. Since Bitcoin has come around, there have been more blockchain technologies, one of them being Ethereum, that all this decentralized finance infrastructure is being built on top of. So now we have cases where if Adam has this $100,000 to lend and Ron needs to borrow $100,000, we don't have to know each other, we don't have to trust each other. The situation before, where I would have to store my money somewhere, Ron would have to go to that entity, prove himself, prove his business plan, prove his credit, and borrow it, and that entity, the bank, would hold the collateral. That has all been outsourced to code now. So Ron can come in here with his credit report, with his collateral, and say, I want to borrow $100,000. I'm willing to pay you 5%. And I can say, okay, I'm willing to lend to Ron this $100,000. The cool part is, I don't have to know who Ron is. Ron doesn't have to know who I am. All I know is this is a wallet, and I have this wallet, and they are conducting this transaction. This transaction technically is called a smart contract, and the smart contract takes care of holding the collateral. It takes care of the interest payment that's going to go through to me. And the smart contract, because it's just computer code, has to take a tiny, tiny, tiny fee. All right, so what we've done is we've significantly lowered the fees. We've also significantly lowered the friction, right? Because Ron doesn't have to go to a bank anymore. He can do all this online very easily. The code takes care of all the paperwork and everything that used to be done. This can be done very quickly. I can get Ron the money pretty much no matter where he is in the world. I can make this loan. So what we've done is significantly cut down on the friction. Now there's still quite a bit of regulation here because I'm still lending money in whatever form that money is. Ron is still borrowing money, so there's still some regulation, and that still remains to be seen how the U.S. government and how other governments will see that. But what we've seen is, in this decentralized way, it's created this ability to offer peer-to-peer financial transactions. And I'll talk in the next video about why that is so important. But that's essentially what decentralized finance comes down to. It comes down to the ability to offer more peer-to-peer financial solutions, thereby disintermediating. That means taking out potentially the banks and the governments that are in between, the banks that cause fees and friction. And that means eventually that these transactions can happen more rapidly, for lower fees, for better investment results, for better returns. And I'll talk in the next video about why decentralized finance is so important and how it affects you, but I wanted to explain first, here's what decentralized finance is. Decentralized finance is essentially taking some of the functions that were centralized in entities like governments and like banks, investment houses and such, and moving those onto some sort of computer code that we can trust so that we can interact peer-to-peer and feel good that money is going to change hands, it's not going to be lost, transactions are still going to be there, but we're taking a lot of the paperwork and accounting and everything and putting it in a code that we trust, and therefore we can have this peer-to-peer financial system. And now what we're seeing is the infrastructure is being built, the code infrastructure, the computer infrastructure, all that layer, all those base layers are being built so that we can feel comfortable with this new peer-to-peer decentralized finance worldwide ecosystem. So don't forget to subscribe to our YouTube channel. Check us out at interaxis.io. Check us out on Twitter at interaxis8. And look for the next video about why decentralized finance is so important.